In our top business story, private sector companies in Dubai experienced another strong improvement in business conditions during September, according to the seasonally adjusted Emirates NBD Dubai Economy Tracker Index. Dubai posting a reading of 55.1, down fractionally from 55.7 in August, but still well above the 50.0 no change threshold. On average, in the third quarter of 2016, the headline index signaled the fastest upturn in operating conditions across the non-oil private sector economy since Q1 2015. September data indicated improving business conditions in all three key sectors monitored by the survey, led by a robust and accelerated upturn in travel and tourism reading 56.7. This helped to offset a slightly slower rate of expansion in wholesale and retail at 54.7 and another relatively subdued improvement in the construction sector at 52.7. According to the September readings, the latest upturn in private sector business conditions was driven by another sharp increase in output volumes led by travel and tourism and wholesale and retail. Although the overall pace of activity growth eased slightly over the month, it remained close to July's recent peak. Survey respondents attributed greater business activity to resilient demand patterns and the launch of new products. In addition, staffing levels increased for the third month running during September, signaling a continued rebound in recruitment since June. However, the rate of employment growth remained marginal and weaker than the long-run survey average. New business volumes also increased sharply, although the pace of expansion eased further from July's recent peak. Companies reporting an upturn in new work generally cited rising consumer spending and successful marketing initiatives. When looking at cost pressures, these continued to moderate in September, with the rate of input price inflation slowing to its weakest since March. The number of new residential units completed in Dubai in the third quarter of 2016 rose to the highest level since Q4 2012, according to a new report by consultants JLL. The last quarter saw the completion of 5,400 residential units, with apartments comprising 63%, the majority of total completion. The report said Dubai's supply pipeline remains active, with a further 11,000 units scheduled to enter the market in the final quarter of 2016, although not all of these projects are likely to be delivered on schedule. JLL said the third quarter also saw the delivery of 51,000 square meters of office gross leasable area. The total office stock in Dubai has now risen to around 8.6 million square meters, with an additional 152,000 square meters scheduled to be delivered in Q4, almost 3 times that delivered during Q3. The report said Business Bay continues to be the focus for completions, with projects also expected to complete in Silicon Oasis, The Greens, and TECOM. The Roads and Transport Authority on Monday officially signed the contract to build the Route 2020 metro expansion with Expoliink, a consortium of French, Spanish, and Turkish companies. Dubai's Transport Authority stated that the project, which carries a cost of 10.6 billion dirhams, covers the extension of the Red Line of Dubai Metro 15 km from Nakheel Harbour and Tower Station to the site of Expo 2020, as well as a supply of 50 trains. The contract was signed on behalf of the RTA by His Excellency Matar Al-Tayer, Director General and Chairman of the RTA, who said in a statement that he was delighted with the signing of the contract, which will encompass 7 stations. According to the contract, Alstom will supply 50 trains, 15 of them for serving Expo and 35 for upgrading the service of the Dubai Metro. According to local reports, the consortium is currently undertaking soil analysis, with drilling works for laying pillars to commence before the end of this year. The test run of the newly extended line is anticipated to start in the final quarter of 2019, and the official service is scheduled for launch during the first quarter of 2020. Dubai Financial Market has published draft rules covering Sharia-compliant hedging, part of its broader efforts to develop Islamic business in the Emirate. The rules aim to expand guidance on transactions that currently lack standardization and would be the third set of rules from the DFM specific to Islamic finance after previous rules covering equities and Islamic bonds. A standard on Islamic hedging could provide greater clarity between counterparties, according to local reports, as the industry makes a gradual shift from customized solutions towards volume transactions, which can be cost and time effective. The rules set parameters for valid Sharia-compliant hedging tools with an emphasis on their underlying contracts and expands on the rationale behind them. The document also defines possible substitutes for conventional derivatives-based hedging, including hedging tools for currency exchanges, liquidity management, as well as protecting against the fluctuation in index-based returns. Islamic finance follows religious principles that ban the charging of interest and shun ambiguity in contracts, provisions which effectively preclude use of traditional derivatives such as options and swaps. The DFM said a public consultation period for the draft rules will close on November 10.